I'm the luxury storage guy on the internet. I do social media to educate. I do some of these things. I've been on Brandon Turner's podcast to talk about luxury store. Ryan Pineda's. I'm looking at doing at Brad Lee's podcast here in a month. So I'm just getting on these really high-end shows talking about a niche product.
Welcome to the Chasing Goalpost podcast. Today's guest started his construction career in 1994, working alongside his father for just $1 per hour. In 2010, with only $2,500 in his bank account, he founded Mac Construction, which now generates over $25 million annually. 10 years later, in 2020, he launched Mac Capital, offering passive investors like ourselves the chance to invest in real estate alongside him. With over 50,000 followers on social media, Marc Kuhn needs no further introduction. Welcome to the Chasing Goalpost podcast, Marc.
Appreciate you, man. This is awesome. Thanks for having me.
Absolutely. We're excited for this episode. And maybe before we get into the world of real estate investing, could you maybe give us a quick overview of who Marc Kuhn is? Where'd you grow up? Family specifics, whatever else you want to share with us. Noting a lot of people already know you from social media, but maybe just for those that don't, give a quick background.
Yeah, man. Yeah. So what I tell most people when I introduce myself is I'm a, small North Dakota kid, which usually puts me in a bracket where not a lot of people are from, because there's not a lot of people there. And then, I always like to tell people I grew up in the concrete business, very, very normal, very ordinary, hardworking kid that always wanted a lot out of life. That's like my staple of my childhood was always construction, working next to my dad, starting at 6 years old. Like I said, I graduated to all the different things through my concrete career with him. And of course, going to school, my parents were divorced. So I'd spend the summers with dad. And then when I go to school, I'd be with my mom all the winters. So just some of the things that I grew up with is in the construction industry, I think is kind of what has bred me to be the person I am today. And it's amazing what the concrete business has taught me. If I reflect and say like, oh, hey, it's going to be windy today. That just means the concrete's going to dry. I'd rather have 110-degree temps instead of 40-mile-an-hour winds, because I know and at the end of the day, what you're going to learn from the concrete business is a sense of urgency. And as most entrepreneurs, you need to have a sense of urgency. You're always trying to, and in your title, you're chasing goalposts. You're chasing the thing in front of you. We're chasing the carrot, right? Like you hear all these different things. But even during I started, I ended up butting heads with dad after college. Worked through him all the way till I was about 20. And then right around my 21st birthday, just before it, I started Mac Construction. Mac Construction, of course, is I started in concrete, started with the things I learned. Why I left my dad's business, just because I wanted to keep creating and I wanted to grow something. Again, I had a sense of urgency and the entrepreneur in me, which I didn't know at that time. Like, you don't know you're an entrepreneur until you start reading the definition of it, or you start doing these personality tests, and they're like, bro, you're an entrepreneur. Like, this is the way you see life. You're an optimist. You're chasing things hard. So I think once I realized that and I started creating, I realized that I started out with someone else's tools when I started my construction company. I had nothing, I didn't have much money. I had to use the guy's tools, but I did all the work in a rural area of Minnesota. And you know what? That kick things off. It led me to that job, be able to get a skid steer. I remember asking my mother-in-law to co-sign a loan for a skid steer, and she's like, this is the last time I'm going to help you. So once you start realizing you're in your last favors and everything you do every day dictates if you're going to get better or what is on the line, you know what I mean? I didn't live a comfortable lifestyle. I always lived on the edge, and in order to grow, you got to be able to take those risks and live with them if they don't always work out, and they won't. Sorry to tell you if you're an entrepreneur, but listening to this. And so it's just going through some of those scenarios. I think as I grew up my construction company, I just learned all these values that I mean, all the way up until like I got up to like 15 people. I was doing a few million a year. I thought I had a house paid for. I was like, man, I am on top of the world. I'm like, this is the American dream I'm living at 26 years old. It's like, wow. It's like, but I also was very chemically imbalanced, meaning I was with some buddies at an event called Heydays, and I know Dustin knows what that is. It's a Midwest snowmobile tradition, and of course you hang out with friends and we are on the way home, and in St. Cloud, I had um, a panic attack. No reason why, not really sure. Apparently, when you go to a hospital with chest pains, you kind of get to the front of the line. Um, and the doctor, asks you certain questions. He's like, "Hey, your EKG's good. You're fine. What's going on?" Yeah, he turns in the psychologist, which I didn't know was happening. I was like, "Am I dying or am I good? Like, what's happening?" And he's like, you're kind of like overdoing it, or it seems like to me. And if you die today, what are you leaving for your family? And kind of told him I had a business that relied on me. Basically, if I died, my wife would sell the assets and whatever. So again, you start as an entrepreneur, you're starting to learn again, and you're starting to make mistakes, and you're starting to create scenarios in your head that I got to do something and build something that like can live, yes, beyond my legacy. At 26 years old, you're having to do these types of things. I was like, I thought I was bulletproof in my eyes. I was an egotistical, concrete guy that just never could shut it down. And that didn't get me anywhere. I didn't ask for help enough. I didn't do some of the lessons. I didn't have mentors. I didn't, I did everything myself. That's the way I did it. And that just ended up costing me a lot. So through that change, and that doctor talked me into, I don't even remember his name. I should find that out. But I ended up figuring out how to start a business, ran a business, a construction company, how to run without me. It costs you margin to do that. Again, another risk. You had to hire people better than you in certain areas. And then once I built that business from 26 to I was probably 31, 32 when I wanted to create Mac Capital, I was trying to figure out how do I create different, we're in North Dakota, so it's so rural. Like you have to end up creating things for your companies. How do I build real estate? And like everyone was asking me, I was starting to buy some real estate and like get into it. I was reading the Grant Cardone books and was in his first mentorship group. Just learned real estate though from him is really what I got attracted to him, and he was yelling it at the tops of the mountains. So I just figured you gotta make money while you sleep. Can you go away for a month and still make money? So just got really curious in real estate, creating Mac Capital, made some mistakes in real estate, tried to create, but I wanted to create a way that passive investors could invest beside me legally and had them to have a good experience. I don't want to let anybody down ever. So I always try to hit certain scenarios before I bring a project into my syndications. But it was just learning that world as a concrete guy construction guy who went into this finance world of investing and numbers and performas and pitch decks. And it was very foreign to me. So I had to ask for a lot of help in this scenario. I had great mentors, different people, and kind of created Mac Capital. It's 5 years old today. I can't. It seems crazy to me that it's already that old, but we got about $60 million, of assets under management already. So we're excited about that, and we're excited about some of the growth that we've seen in our luxury storage product. Not only that, I'm still trying to do multifamily. I think it's a good smaller tool, but I am definitely all in on storage just because of the reasons of recession, non-recession, and we could probably jump more into that. But that's my story that some people know and some people don't.
No, that's good, man. What a journey. Thanks for sharing that, by the way. And I think there's a couple themes that I pull out of there was number one, legacy, right? I think as we all age and you have, health scares or you're just getting older and, as I look in the mirror, my beard's grayer, I start thinking about it a little more as well, right? Ultimately. And then, I think the other piece of your journey that you just mentioned is, and we talk about this all the time on the podcast, but overnight success. I mean, your construction business is 15 years old. You've been doing it since 94, right?
Yep.
There's a few years of experience and blood, sweat, and tears there. And then, the Mac Capital piece, like number one, congrats on the success, right? But it's 5 years deep and you've gone through a lot to get to where you are, all those assets you just mentioned, right? So I think couple good learnings for the audience here is legacy, and the other one I pulled out was mentorship. I think we all, we've talked about this as well, but you and I've talked about this off record is we go to school and we have teachers and professors in college and then coaches throughout your athletic days if you're in sports, and then you stop. You go into the work world and you're like, "Nope, I'm good. I'm just gonna head out and figure it out on my own," right? And just kind of forget about the
Mhm.
importance of mentors and coaches. So anyway, I just wanted to call those themes out because I think those are important for all of us to hear and appreciate you sharing those. Maybe as we
Excellent.
kind of transition, yeah, sorry, as we transition to the next topic, let's dive into just a little bit more about Mac Capital. You got on your shirt there. We're going to talk a lot more about syndications and passive investing, but maybe just give an intro for the group to hear.
Yeah, so Mac Capital, founded in 2020 and is really was my passion project because I started learning. Obviously, I was starting to learn how to get things to operate, how to make money while I'm sleeping. I think I didn't want to get rich quick. You can sometimes do that in business or different scenarios, but you want to get rich for sure and create wealth, legacy, impact. And I try to teach that. There is a life outside of 401k, which is taught. So it was my passion project to say, I can make this simple for you. I can educate you. I can talk at this, and people were listening to me. And so then even social media came around because I was trying to get a message out, and it's not that I'm always just going after investors, but even the young 22-year-olds that don't have a dime to their name, it's like, how can they start now? So like, because real estate very much is a 10-year game. It takes a decade to really make significant money in real estate, that can impact your entire life. And there's some pain at the beginning, right? And so trying to teach people how, cash flow, appreciation, performance, those types of projections can work. But I mean, real estate's been in a little bit of a rut for what, a few years now? It's like there was such a spike in COVID that, um, you know, Mac Capital it's been challenging for any syndication type operator, but it's been very challenging. So you had to really niche down, and Mac Capital's really turned into a luxury storage. We raise a lot of money within the luxury storage product type, and in a world where it's really hard to raise money and the economic uncertainties, we're able to raise. Just this quarter, we're raising $5 million for a couple projects that we have going on, and have raised already a significant portion without it even being live on our thing. So it's like that type of thing means, the riches are in the niches. So that's what I've really tried to get down to, is not just being multifamily, not just being self-storage, but how to find the path of luxury storage. And yeah, I'm super excited about Mac Capital, and I got a growing team, which I love, and they take care of me and the back end type things when I'm not the finance guy. I'm an entrepreneur. That doesn't mean we're spreadsheet gurus by trade. It's not my thing. But I'm able to do general performance and know if a project's going to work before we even get to that point. So, but yeah, that's really Mac Capital. I mean, it's a shorter story. 5 years old, a lot of learning lessons within that. That's generally what we're about right now.
No, that's great. And we're going to dive a little bit deeper into some of the projects later in the episode, and appreciate you giving us a little bit of context on that. But I do want to kind of shift to active versus passive investing. I think this is a debate that's always ongoing online. You've talked about this, a lot of your content, on this podcast and this platform. We've got a lot of 9 to 5ers, professionals that are looking to take their capital and build horizontal income streams. And we say horizontal because a lot of people think that, this passive income is thrown a lot on social media. You've talked about it. And I think the reality is, for secondary income streams, typically they're active or semi-active and
Mhm.
not passive. But I know we're going to get into why we think that, your model is passive, but maybe initially before that, maybe can you help us understand just the difference between active and passive investing, specifically in real estate?
Yeah, well, I think you got a couple different forms of active investing, right? Like you could talk about the syndication model, which a lot of your, people are understanding of that. It's a GP, a general partner, and an LP. But and then you have, different forms. You can make money through wholesale, flipping. You can be an active partner in anything. Oh, and what I always find out is you get I always use the example of the doctor because there's investors like this all over, and they have very high income. Always want to participate on the upside, meaning being the active investor versus being the LP. And they can, as a doctor, you can't be both like a real estate professionals from a tax perspective where you can actually wipe out your W-2 or your high doctor income. You can't wipe it out because you can't be a doctor full time and in real estate full time, right? Like that doesn't make any sense. So, um, but where I have seen a change for that, and this is a good example because doctors will want to be active. they don't know more about real estate than you. Obviously, we live in it every day, but it's they want to share on the upside if they're going to be a significant investor or whatever. But their spouse sometimes can be, the real estate professional, and they can participate because they're married, filed jointly. They can actually gain the depreciation from the asset because it'll wipe out their W-2 income tax. You can, if you're a high net worth individual, we all know how much you pay for income taxes. It can make anyone sick. And so a lot of times I'll just educate the spouses even, and I'll do that through Mac Capital. And this isn't really the difference between active and LPs, but this is just another example of how you can be kind of share both upsides. But another active investing is I always find the LPs. So the LP is purely a thing that should be on cruise control. You should have no say. You should get reports from a GP. You can voice your opinion and influence the GP. Sure, you're not going to be able to drive the project necessarily, and if that's your goal as a LP, you might want to just figure out, how do I get to be an active investor? But if you're also an attorney or something else in that trade, I don't think you should. And here's why. Because being an active investor, being a general partner, there's a lot of pressure, right? You gotta take people's money. You gotta follow SEC rules. You have to, um, you know, uh, account for the investment. You have to manage the money. All this takes time and effort. And really, to be honest, on the GP side, all of the management, people think you make money on asset management fees and all the property management. I literally do all that to a break even. I've done property management for a couple years, and I've done different things. And what I found out is the management piece is a tool, but is not something that makes significant money. It doesn't. Maybe if you're doing billions and billions of dollars, but it's not. As a GP, it honestly even costs me money because you have to build this team of people so you can operate these projects, but you're not necessarily making any money from that. And so sometimes people will see the fees and it's like, literally, you're just trying to break even. That's literally what you're trying to do. As a GP, you do earn some sweat equity in the project, right? Like that's our carrot. We usually get paid last in the deal too. So people will say, "Oh, I'm going to quit my job and I'm going to go be a syndicator or an active investor." Well, I'm like, okay, well, do you got money for 5 years? Because that's going to be your first refi probably where you actually make some money. Everything else will be literally just enough fees so you can like spread butter on toast every morning. You know what I mean? Like you're not living large, but if you have a subsidiary company like the construction company, now you have some cash flow, right? I don't need to charge all these fees and get all these things. But I think in order to compete in the syndication space, you can't overfee, you can't overcharge, you're not going to make money till 5 or 10 years down the road. And that's just the way it is. And so you got to be able to accept that. So most LPs will ask me, what does the GP side look like? I'll show them. I'll show them what my overhead is. I'll show them, like, I'll get in the weeds as much as you want. And then they're like, yeah, never mind. I like the LP side, so I get paid first. I get the depreciation. I don't need to listen to any of that. Just report to me what you need. So it is interesting to me, whether you're thinking about being an active investor and thinking about all this upside. Yeah, there will be upside. It'll just not be for a while. So you need to accept that. And there's a lot of pain sometimes to get there. You're worrying about, we're in that March timeline. You're worrying about K1s. You're worried about, investors are getting hold of you. So it's when you're doing all that for free, sometimes people aren't willing to do that, and they have to overcharge the project so they can pay someone else to manage the asset, and it just doesn't work out. So, you know, my my dream when I get older, I'm going to be a professional LP, meaning I'll understand the operator. I'm going to understand the project. I will invest in one project and I will help that operator if I can. But you know what? I'm going to pass the wand and I'm going to just, when I grow up, I want to be an LP. I think every kid should say that and be a good LP because I think that'll go much further than trying to do everything yourself. So I've been through both scenarios and I think an LP is what I want to be in my future.
I agree with that statement there, but I think maybe I want to back up a little bit there, just because I think for you and I, we've got some familiarity with syndications. For the audience that doesn't have a lot of familiarity with syndications, what actually is the definition of an LP and a GP?
Yeah, so a GP would be your general partner, right? Like your person that is operating it. Call it's you got the jockey and you got the horse. The real estate deal being the horse and the jockey's the operator, right? And then he makes all the shots when he's on the horse, right? And then this is just a metaphor, but it's like he makes all the shots. You can't help him when he's out there, right? And you can invest. You can bet on that horse, right? And that's basically what you're doing. You're investing in the best horse, the best odds. You feel comfortable with the person. They have the same views you do, and you could trust that person. That is the most important piece. The operator is such the GP is such an important piece over the deal even. So with that being said, an LP hmm, is that guy who's vetting GPs, right? Like you want to be the hands-off guy, you want the depreciation, you want all the benefits of real estate um, without having to actually operate it. It is challenging to operate real estate. Some people, there's so many myths online of just buy it and it'll go up in value. Well, for the last 2,000 years, they're not wrong, but it is challenging to operate these deals with the cash flow that you need, um, with high interest rates, low cap rates. It's a challenging piece, but being the LP is completely hands off. You don't have to do anything. Someone reports to you, and you learn. You can be a great LP for 10 years and learn a lot and maybe work your way up to that. But you just got to know what you're stepping in once you're leaving that LP zone. Again, I'm going to move into the GP down to the LP at some point in my next 20 years, but I'll learn some more along the way. So
That's great. I think we just are in a scenario here so the audience understands even a step further. So if you and I are sitting here, right, and Matt
yeah,
Capel and Mark Kuhn, you are the GP in a deal. You build, you develop, you do all that, you manage the project. And if I'm an investor, I'm an LP, and I would essentially invest in your deal, correct?
yep,
Passively in that way that, I'm not up at night worrying about, the covenants, things like that, right? Making sure that
yeah,
debt to equity ratio is there, all those types of things. That's your job. But I think a lot of
yep,
people, to your point, they want the upside in real estate, but they don't want the risk.
right, yeah, that's very true. No, that's you nailed it. It's basically that last sentence there hits it.
Well, good. Maybe just as we, think about this a little bit, you talked about, one of the things I want to hit on here is as we think about investing in real estate syndications as investors on this podcast, becoming an LP, what are some of the things that we should be looking out for as we evaluate GPs?
Yeah, and like I said, it's going to be you will find a lot of GPs, not all of them, social media, but you got to find someone that you enjoy working with, right? If you're the black and white finance guy, you might want to find another black and white guy that lives with your views and your understandings of a deal. A lot of entrepreneurs invest with me and they enjoy, what I do and what I talk about. But as an LP, like some of the greatest questions I get asked are about myself. I can tell the more experienced LPs are like, well, what do you believe in? Because I've been doing it 5 years. It's still not, I'm not, it's not like I lived through the financial crisis and I'm like, I know all of this, but they know how, if I do hit a hard situation, that I'll react in a certain way and I'll have a level of transparency. I tell them that nothing's perfect. If I had the perfect perform every time, I said I probably wouldn't be here. I would be somewhere else. And so I think when you're talking to a GP, you're interviewing him. Ask him what's your hobbies? What do what's your vote? What are you, a family guy? Are you a bachelor? Do what else do you invest in? Um, I would spend as much time getting to know that person than actually talking about what's because then you have the other world. You have the questions that people will Google, and it has nothing to do with me. It is like, okay, how much do you believe in that 15.8% IRR? And how do I, when I know they ask about the IRR, it could be a family office, right? This is This is a transaction to them. This is just placing money. They don't care about me. They do, but less about me. They care more about the deal. Um, and I think that's a mistake in most cases, but, like, they need to invest minimums, and they have to hit minimum returns. It's like, "Okay, we don't invest until it hits 18% IRR." Okay, great. Hey, I'll change my exit cap rate by 1/4%. Wow, congrats, it's 21%. You know what I mean? Like, um, and so and I'll share that transparently, and I'll even show them the performa live in front of them, you know what I mean? It's like, "Oh, well, I want you to look at this deal. We're getting a 26% IRR." I said, "Well, your exit cap rate's 4 and a quarter." So it's like, "How much do you believe in that?" It's not realistic. It's very optimistic, pitch deck, but I don't think and then so what I'm getting at is trust your operator. I don't think this should be just a transaction. Is there things on the deal? Ask them the weaknesses of the deal, right? What's my potential risks? And if people come to me for luxury storage, they're like, what is that? Why would I invest in this? It's not really proven. You're not wrong. I'm not saying you're wrong. It's not self-storage. It hasn't been around, I don't even know how long self-storage has been around, but forever, it's like as far as I can remember. And multifamily, it's much different. But I said our margins are a little bit better. We're a niche product. We're offering to a different demographic than just, say, people moving from apartment to apartment. Um, we want a premium clientele, and I always think like, um, Alex Hormozy, you wanna be in the best product type, you wanna be in the Rolex, you wanna be the highest end, you don't wanna just build a watch, you wanna build the best watch, and so, anyway, when you build in those kinda niche classes, you get a different clientele and you can really learn as an LP. So, I just try to educate the LP is what I try to do. I think as an LP though, please, please just ask and trust like you can ask for references if you want. You're likely to find out exactly what that LP has figured is like, outside of the deal, I'm the same way inside of the deal. I'm doing media, I'm doing video, and for myself, but you gotta be able to ask, trust that operator. I guess I'm just those are the best investors I have, is what I think is when they ask me those questions, and I have a personal relationship. I don't have just a transactional deal relationship to them.
I asked you that question on purpose because I wanted to pull out the capital T trust on that one, and I'm gonna go full disclosure here with the audience, like, my wife and I, we invest with Marc and Matt Capital, right? And so I want everybody to understand that, and, I think the reason why I'm sharing that, Marc, is because when you and I initially started talking, it was the first 1 or 2 or 3 calls to get to know each other. You're like, "Hey, what are you looking for? I'm looking for X." We
Yep.
provide that, that path, and so making sure that I think your goals are aligned with the GP and saying, if my goals are X and the GP's is Y, probably not a good fit. The other piece of that I think I really appreciate with your approach is you explain the stabilization process. A lot of
Mm.
investors walk into these deals and they say, okay, they think I'm going to buy a rental condo and I'm going to rent it out to my buddy next door. And 1 month later, I'm going to have rental income coming in, right? Where these deals, you're building them from scratch, you're stabilizing them, meaning you're getting them filled up, whether that's storage projects or multifamily. This stuff takes time, to your point.
Yep.
And so I think it's about trust and transparency, and that's what you said. And so that's what I really want the audience to hear here is have these types of conversations and make sure that number one, your goals are aligned, but make sure you have that trust in your GP.
Yeah. You're honest point with the stabilization when you're an investor in a new development project. New development can be shiny, bright, beautiful, but it takes time to develop that asset. The value add deals are much different than they used to be. You can just go buy existing assets. Really hard to find margin for your investors in buying right now. And if interest rates keep coming down, it's only going to get harder. So we have to lean more into development. Obviously, with my verticals with construction and concrete, different things. Um, I think you can create these new product types, and they're institutional quality. I have a list of planned buyers who, if I hit 150 million, they're buying them. So it's like, I just need to build that, keep it super simple and just build a product type that I know I can exit. And if I can do that enough times and get enough property underneath my belt, I know that private equities will pay a premium for stabilized storage assets, flex industrial space. They love it because it depreciates really well. And so I always just work backwards but you have to realize as a new development, the point we want to get at is stabilization. Some people don't understand that. Like Dustin said, stabilization, you have to build it, stabilize it, and then it's some cash flow, right? Like it's not the other way around. It takes time to do that. And I'm getting smarter all the time on how long it takes to stabilize and how do we build faster. You know, even building, it's so funny. Like I look and so people that are looking at new development projects, typically like a luxury storage product, it takes us 6 months to build, 18 months to stabilize. So it's a 2-year deal where your money is really it's at work, but it's not like we're sending you money every day. And that's a process that what it takes to get in development. And so, if we can build in 5 months and stabilize in 14 months, we can save 100 grand on the business model, right? So I'm chasing that as hard as I can. How do we improve? How do we get there faster? How do we market better? How do we run the operations better? How do we find brokers that'll work for us for commissions and try to fill these units as fast as possible? So it's like there's all these different things. I love the fight of that. I love to build a 24-month plan and beat it, but it's not always feasible. You got your different challenges, but it's your money, you're not making cash flow during the process. And that's some investors cannot live without that. But I'm very transparent about how that works. And I don't bake money. Some people will bake money into a deal so they can pay you a 4 or 5% dividend while they're doing construction. But I don't see why I would charge you the money to pay it back to you over time. It doesn't make much sense to me, but that's me.
Yeah, no, and that's why I think a lot of people invest with you, right? Is because of that trust and transparency. So, kudos to you on that. And for anybody listening that wants to have a chat with Mark, we'll work on that later and make sure you've got the links to connect with him. But one of the things that I want to chat about too, Mark, you've educated me a little bit on this over the years in the syndication world. Is there's accredited investors and there's sophisticated investors, and I don't think most people really understand the difference. They might say they do, and I think maybe could you just kind of run through an accredited investor versus a sophisticated investor, and then maybe are both able to invest with you, or is it one or the other?
Yeah. So to to make it in the most simple terms, let's just talk about the sophisticated investor. This would be the everyday person starting to learn on YouTube University, starting to learn what is real estate. Maybe they have 25, 50, 100,000 to invest from a 401k or a self-directed IRA, whatever. Or maybe they just have the cash set aside through inheritance or whatever it would be, right? So
Mhm.
they don't really understand real estate, but they hear the buzzword, right? And so most sophisticated people, I will say, have graduated from YouTube University. They understand like what the deal is. And maybe they attended some of my webinars or other people's webinars that say, hey, this is how the depreciation works. This is how appreciation works. This is how, cash flow can work. And this is the journey of the real estate deal. There's a lot of myths out there that you go buy 3 homes and you're gonna make $1,200 a month and each, and you just quit your job tomorrow. So, um, I make sure that if they're sophisticated, they can answer, at least the questions of, uh, I usually go down the route of depreciation. If they can understand that, you got to go a little deeper in the weeds of how that works and what cost segregation and bonus depreciation, some of these terms, if that's all foreign to you and you're listening to this, start going to research that. I promise you, you're going to figure out everything else along the way and you're going to understand why the wealthy invest in real estate at the end of the day. Um, hmm. Well, let's move up the line to an accredited investor. So this person's probably invested in real estate before, not necessarily, but sometimes. Um, I know that some of the income things are changing right now. I know you need to do 300,000. Correct me if I'm wrong, but it's 300,000 filed jointly. I believe you need to have as a spouse to be an accredited investor or make a minimum of 250 as a single. Is that right, Dustin?
Yeah, I think so. I'm following the tax changes here too, as well as
Yeah,
the
and
lump
so
changes.
and you're gonna want it. You can Google what is a credit investor. Obviously, it's gonna give you up. You have to hit some income requirements to basically say, you know what, if I put 100 grand somewhere, I know what I'm doing. Now, there's different ways that, like as a GP, we have to sometimes in a deal where We need to verify you're accredited. It might be from your accountant, from your CPA, from maybe it's from a program online that you have to prove like $1 million of net worth. These rules are like literally getting changed right now. I don't want to like hit the point on that, but I know the last rule I just heard from Mauricio Rald, who is my attorney in this syndication attorney, that if you have $200,000 hmm, of I don't know if it's income or anyway investments that you can actually be qualified, or if they invest, no, here you go. If the minimum to invest in a deal is $200,000 minimums, you instantly, because you can invest 200,000, become a credit investor. Now, again, that could be a guy with his inheritance, what a you know what I mean? Doesn't need that they're accredited, but it means that if you have $200,000 to invest at a minimum, you're considered to be an accredited investor. There's different requirements though, like if you're below that. Um, and and there's two types of deals. There's a 506. There's more than two types. There's types that you need to know on this show. It's a 506B and a 506C. The biggest difference is a 506B, you and I need to have a relationship for you to invest in my deal. You do not need to be accredited. I don't need to verify any accreditation with a 506B deal. You can just, as long as we know each other, we have vetted each other, we talk to each other, we have a pre-existing relationship, you can now invest in my deals. Um, and so that's very simply pre-existing relationship is a 506B deal. It's 90% of deals out there. And then the rest of the 10% of deals are probably influencers and people shouting out the mountaintops, or a 506C deal. So if you know Grant Cardone or Brandon Turner, they're on social media and saying, invest with me, 12% returns, whatever they're saying and selling. That's a 506C deal, meaning you must be an accredited investor to invest in that deal. And you have to prove accreditation, whether it's CPA, attorney, whatever you means you can have. You have to prove that you're accredited, and the GP has to accept that, and then you're able to invest. And that's because you're screaming at the mountaintops in a 506C deal that you're just collecting money from people you don't even know. It's something I don't really like to do, and don't like to do at all, because I told you I like to have these relationships. One bad investor can make your life miserable as a GP. And you don't want to go through that as a GP either. And if an LP and a GP don't align, it's like, why would we invest in the first place? Well, because I blindly invested because it said 25% IRR and 12% cash flow. And then all of a sudden it ended up being something else. So those are some of the scenarios. But your 506B, pre-existing relationship, non-accredited, and the 506C must be accredited. Scream at the mountaintops.
No, that's great, and I think that's the headline for the audience here is 506B, 506C, and again, I think the disclaimer and disclosure here for us is everybody should be doing their own homework on this stuff, right? And, get legal advice on your own, get your own accounting advice. We're not giving advice here at the end of the day, but, make sure you understand it, because you said the rules are always changing, and, the accredited investor the definition in my mind has always been $1 million in net worth, not including the equity in your home. Right. And so that's one piece of it, but there's other pieces of it. So again, everybody make sure you're doing your homework, making sure you're not, misrepresenting yourself with any of these GPs as well. So that's great. And it's good education for this group as well. Cause most of us, before talking to you, I hadn't heard of 506B and 506C, right? So it's just kind of, those are just numbers on a sheet.
Yep.
So maybe just give us a quick overview of maybe some of the deals of whatever you're willing to share of the deals you've launched, built, and closed to date, and maybe some of the ones you have in the pipeline. If that way, people can get a kind of an idea of what you've built and what you're building coming up.
Yeah, so, when I first started in syndication, like I said, I learned a Grant Cardone method. You always need a place to live. So I started out in the townhome communities and started putting my first syndication together, Thames Crossing, which was 22 townhomes. And we're a few years into that deal. So when rates were cheaper, it was a little bit easier to make anything work. Well, I like learning in these hard times. I mean, I started my construction company in 2009. It wasn't necessarily the best time to be starting anything. It was challenging. And when I started in 2000, rates were cheap, and it was like, "Oh, this could actually work and make it, yeah, real estate's great." Well, all of a sudden, 2022 hits, and it's fear, doom, gloom, higher rates, and it's still where we actually live today. That's why real estate's been so challenging. Um, but, as I've converted, I've done townhome deals, I've done apartment deals. These are all new developments. That's all I've syndicated. So if you're into new development, that means, that's the exact product type I do. But I do offer my investors, I think, once you have a pre-existing relationship, there's so many smaller deals that you will see, like maybe a distressed builder, and we bought 10 homes from him. And, we got them for 30, 40 grand under appraisal. So it's like we can make a deal like that work. Well, we offer our investors other scenarios. Maybe it's a sub debt opportunity, providing just hard money on the deal. And you got different investors that love the cash flow of just debt, and maybe their equity is poured into their business and they're so equity heavy. They're like, I just need some debt, and these treasury bills aren't making enough money. So we don't just do new development deals, but I have all these side deals that I'll end up pushing through my portal and to my investors that invest with us. And the latest deals that I've done are, I've bought more townhomes from distressed builder. I've bought homes from distressed builders, because I'm in the construction industry. I know some of these people, and some of my investors are looking for those types of deals. So those are usually my closest investors. Those investors that invested with me prior, guys like Dustin, they see some of those deals before anyone. Um, and and then I have, the luxury storage now that I've leaned in the last 3, 4 years really heavily. I'm the luxury storage guy on the internet. I do social media to educate. I do some of these things. I've been on Brandon Turner's podcast to talk about luxury storage. Ryan Pineda's, looking at doing a Brad Lee's podcast here in a month. So I'm just getting on these really high-end shows talking about a niche product, um, because I think it is a wave. Flex industrial is the wave of our new industries. You gotta think, 3 before COVID, there's 3.5 million new businesses each year, and ever since COVID started, what has happened? People wanna work from home, people wanna start their own gig, they wanna consult, they wanna have money, time, freedom, all that thing, they want their time back. And when you do that, you end up leaning into real estate and literally learning the myths that, like, you just don't buy a couple townhomes and cash flow for 4 grand a month, and it's just not existent anymore. But you learn that, you know, investing in real estate is important, which I do like. And I think real estate in anyone's portfolio is like the best thing you could ever do. But just understand it's the long game, not the short game in that asset type. And yeah, I don't know. It's just hard, like educating people into luxury storage. It's like dude, it's went like wildfire. I don't even know how I came up with luxury storage. I think I just added the word luxury and storage, which is something really cool. It's something really boring. And I love how boring storage is. And I love recreating it. It's been an absolute blast. I was asking Jen, my assistant, I was like, how do we even come up with this name? Like, when did I start even like, I think like one post hit on it and we're like, well, let's say it again. And then let's say it again. I'm not really sure, but I know we were using it and in our social media, and everyone was like, "Hey, tell us more." And so, ran into a niche product type. It's been a fun journey of like educating people, but it's also been fun bringing those different projects to our investors, and they've loved it, investing in it. I have repeat people who just love the asset type. They love my business plan of, hey, every 5 years, let's roll these suckers up, sell them off to a private equity who can pay a lot more than you and I have, and let's just go do it again. Like, let's just keep it simple. So, and that's really what you'll see with me is I always keep it simple, stupid is like my motto.
The KISS model, love that.
Yep.
That's what we used to talk about in hockey all the time. So use it
Yep.
in business as well, right? So
Yep.
listen, well, I think lean into that a little bit. You've talked about some of the asset classes that you do. You've educated us a ton today, right, on LPs versus GPs and 506B, 506C, you name it. But I think we all realize there's a lot more to learn. And Mark, you educate a lot on social media. You've got a newsletter that comes out every Saturday morning. I just picked it up again this morning, which I appreciate. That one was about vertical integration of a GP. So you're constantly educating. But if someone wanted to connect with you on social media, connect with you and your team at Mac Capital on any of your projects, or just sign up for your newsletter, where are the best places to go to connect on those?
Yeah, you know what? I send everyone to my LinkedIn. LinkedIn is really where we live. It's where we push our email. You can subscribe right on there on the like the heading link, subscribe to my newsletter. From there, you can even check out my YouTube if you want some more video content. I try to push at least a video a week and if not more at times. So I spend a lot of time within those two platforms. I'm on Instagram, TikTok, you name it, we're on it. Trying to educate and do different reels, and it's been a fun process. But like, yeah, I think at the end of the day, like people with that newsletter, I did not know that would be as a powerful tool for myself. But it's like I have like 40 people paying $9 for a free newsletter, and I don't know why. Um, they love the value. They want me to keep it going. Now we're starting to get sponsorship things on it. So it's like it was just a free email. Like I'm just telling you the deals I do. You can look through. I think I don't know what we're on, month 80 or something. I mean, we've been doing this for a while, and I'll literally go through like line by line item, like my businesses or a deal. Like I'll show you the settlement statement. Like I try to get in the nitty gritty with the story and how you build it. And so, dude, I've inspired a lot of people with that newsletter. I did not realize that people would enjoy that much. There's not a lot of feedback you get from it like all the time, but like the fact that people are paying for a free newsletter, to me, they're like, we're going to turn this on and just see if anyone does it. And like, it's not, about the $500 you're going to make a year on it. It's all about the helping of people. So, if you're not subscribed to that newsletter, and follow the Herd newsletter, it's just like my podcast. Make sure you're subscribed to that, man. It's free value. We try to really every week try to provide as much value as we can.
Well, we'll get some links out in the show notes to number one, some of your social profiles, maybe your website as well, and definitely that newsletter so that people can chime in. Because I mean, obviously, people are seeing value in it. I'm seeing value in it. I get it every Saturday morning, just so everybody's aware. You sit down at your computer, review your emails, and it's sitting in there. So, listen, man, we really appreciate your time. You referenced a couple things. You've been on a lot of big name podcasts to date.
Yeah.
You're going to be on a lot more coming up here. And so I think for the audience, I think I speak on behalf of myself and the audience, really appreciate you taking time today to come on with us and educate us. And again, man, you've got a great product and a great business. And, obviously for anybody interested, make sure you're reaching out to Marc and getting connected and learning more. But maybe as we transition to a close here, Marc, I'll just, is there anything else you want to share with the audience today? And with that, I'll give you the floor.
Yeah, man. I nothing nothing I don't think I need to add. Feel free to reach out to me. I always try to help as many people as I can. If you got any questions, make sure you subscribe to all the channels. I definitely push everything I'm thinking about and everything I see coming out or coming up new. I will push out on that. And Dustin, I appreciate you and your trust in me and bringing me on your podcast and letting me share my story, because I think I try to stay humble and I'm a pretty ordinary guy at the end of the day trying to do big things. So I
Yeah, well,
appreciate
we want to share the word. Absolutely, man.
Yeah.
We want to share the word because I think it's important too for people to understand that, there's investment opportunities. At the end of the day, this is just education, right? Everybody's got to do their own homework, kind of disclaimer here, but there's real estate rentals, there's, commercial real estate, there's stock investing, and then there's this real estate syndication piece that I think people kind of aren't quite as familiar with. So I think today was a great start for them. And if they're interested in that, they know where to go to find out more.
All right. Appreciate it, brother.
All right, man. Thanks for your time. Cheers.
Yeah.
Thanks for joining us on this episode of the Chasing Goalpost podcast. Just a reminder for everyone that all of our disclaimers can be accessed via www.chasinggoalposts.com/disclaimers. We'll see you next episode.